This is my financial disclaimer so I don't get sued.
Good morning, good evening, good whatever time it is you're listening to this. I hope you're having a good one. Let's take a look at what we're covering in today's video. In today's video, I will be going over quite a bit as this is the standard weekly video. Now, again, there's quite a lot. I will timestamp everything, but I do want to highlight I will be streaming the trading sessions from Monday through Friday, 8 a.m. through, it says 10:30 a.m., but I meant 9:30 a.m. Eastern Standard Time. Um, unless there's a holiday or I mentioned otherwise, I'll be streaming Monday through Friday. Now, with that said, we'll be going over the data sets and earnings, the Fed Watch. I want to take a look at the Challenger report. It's not written on here, but I do want to take a look at that. I do want to show the temp hires and why do you think that a lot of the employment data isn't, or the unemployment data isn't going to come in very good at all. Then we're going to be going over quite a bit of technical analysis. So I'm going to be covering tech pretty in detail. So I'm going to be going over a very detailed analysis of the SPY, and then I'll very lightly cover the QQQ and SOX, which is tech and semiconductors. Then we will be taking a brief look at the high yield corporate debt, so the HIG, junk, I know it's a funny symbol name, but it's JNK, and then liquid, so LQD. After that, we'll be looking over the US Treasury, so TLT, the US 10-year, a couple other symbols that have to do with the Treasuries. We'll be looking at the dollar, so specifically the DXY, and then I do want to take a look at the yen and the US dollar slash yen pairing, which is the USD JPY. And then I briefly want to look at volatility, so we'll be taking a look specifically at the VIX and the VVIX. Then precious metals, so specifically we'll be taking a look at silver and gold, but we might briefly look at the actual futures version of those as well, as well as their ETF versions. And then for Bitcoin, we're just going to go over Bitcoin. I'm not going to go over Ethereum or anything. And then for oil, I just want to briefly look at USO and WTI. And with that said, we'll go ahead and get straight into the data sets for the week of February 9th, 2026. And getting into this week's data, I really want to start with last week because I know that I did not get to cover Friday's video. So going over the data sets for last week's just very quickly for Thursday and Friday. Essentially, we had the JOLTS job openings, we had the jobless claims, both the continuing and initial, and we had the Michigan inflation and consumer expectations. Now, overall, the data was very cool. We had the JOLTS job openings coming in very, very low, which continues to go back to what we've been discussing, where the labor market is in the current conditions where it's basically a no hire, slow fire. We're seeing the continuing jobless claims slowly starting to pick back up again. It's still not within that dangerous range, but each and every week we've been seeing the initial claims just continuing to rise and rise and rise. So, what I feel like is happening is we're seeing a lot of people dropping off the continued claims, whether they've ran out of time to be on their unemployment benefits or whatever the case might be. Um, these people are not being hired. So what's happening is these people are falling off their benefits while new people are starting to begin their benefits, which is why we're starting to see the continuing claims pick up again. The JOLTS job openings, it's not the most reliable data set in the world. However, it's, you know, one of the data sets we do have, and it's telling us very, very clearly that the job openings is just dropping massively. Each and every report has just been going down and down and down. The Michigan inflation expectations, they're actually expecting quite a bit of less inflation over the year. It was previously at 4%. It was forecasted to be 4%. It came in at 3.5%. So obviously the Fed is seeing some issues popping up that's going to affect some of the upward inflation risks. Consumers basically came in within the forecast expectations. Now, the consumer expectations went down very, very slightly while the consumer sentiment went upward. Um, in total, I kind of just read those as neutral. Overall, they weren't really positive. These are still very, very not so great numbers. Um, and then we saw consumer credit raise drastically, so a lot of people are starting to jump back into their credit cards and everything. So, um, okay, going over this week's data sets. We have a lot of data this week, but it's truly only a few major days. So on Monday, as you can see, there's really not a whole lot of data. We have Fed Waller speaking at 1:30 p.m. I'm not really going to add Fed Bostic. If Bostic says anything important, it will come for Tuesday. Now on Tuesday, we have quite a bit of data sets here, but really it's not a whole lot. At 8:30 a.m., we have the ADP. It says 8:15. It is at 8:15, but we're just bundling it into the 8:30 data sets. So 8:30, we have the ADP weekly. That's been coming in very, very low. And last week it came in lower than what the forecast expected as well. So we have retail sales data, so multiple different data sets from retail control, retail sales, or retail sales. We have the employment cost, so that's showing how much companies and everything have been having to pay for employment costs, whether that increases or decreases. That basically showing whether companies are starting to hire or starting to let go of more employees. If the employment costs are increasing, then obviously they're paying people more. If they're seeing a decrease in these prices, then or in the cost index, then they'll be seeing, you know, very likely layoffs or massive just reduces in people's wages or something very kind of unhinged. So um yeah, that's important. Now we also have the export and import data, and again that ties in very much with the GDP. We've been seeing the import prices really, really, really mess up the GDP readings. And that's because the imports have basically been coming in very, very low, which adds as a plus towards the GDP rather than taking away from the GDP. So when the imports aren't going anywhere, it's not a good thing. And seeing the forecast for this week, both the export and the imports are expected to come down pretty drastically. Um, Previous week they were at zero point 0.4 and 0.5% respectively. If I read that correctly, yes, they're expecting a 0.1%, so not good at all, and that will reflect on the GDP, pretty immensely. We also have, let's see, retail. Yeah, covered the 8:30 time slot. That's good. So 10 a.m. we have. Sorry, I have to read my notes. We have the business inventory data, which we're keeping track of. It's not something major right now, but it's something that we've been talking about. We've been seeing a decline in the business orders. We've been seeing inventories really just starting to dwindle down, and not a lot of companies are really picking that stock up. The forecast this week is really kind of portraying that as well. Um, I don't really expect this to move the market a lot, but it does play into a lot of what's actually going on with the real economy. Now at 8:30, we have the Atlanta Fed GDP now. The forecast is 4.2%, but based on the export and import price and the data we saw last week, I actually expect that to come down slightly more. And then at 1 p.m., we have the 3-year no auction. So really fairly busy day in terms of there's a lot of data sets for the time slots, but it's mainly just those 4 time slots, and out of those time slots, it's basically going to be that 8:30 time slot that moves the market or not. So don't really over concern yourself with how much data is coming out on Tuesday. Now for Wednesday, it looks like a lot of data, but again, it's not a whole ton. It is very important data though, We have the average hourly earnings year over year and month over month for January. I anticipate those to go down, and the forecast does as well for the year over year. Um, Again, this is tying back into the labor market. This shows that if people's wages are going down, the average hourly earnings, then that's either showing that one, there's less headcounts, or two, that they're just cutting people's wages. So one of the two. Now, we also have the non-farm payrolls, so the NFPs. We have the participation rate, which is very, very important. Now, this is something we haven't been tracking a whole lot, but as of the last few ratings we have, now the participation rate is very, very crucial because it's kind of an indicator for the whole labor market, whether we're seeing more movement in the labor market or not. And that's from the hiring, firing, um, whether people are trying to participate in trying to be hired, just the whole kind of gambit. So it's really important, and it's something that just a lot of us don't really look at enough. We have the payrolls, obviously, very, very crucial. The unemployment rate, obviously, very, very crucial. Now, I have not checked if the individual state data has come out yet. If it has come out, then we'll talk about it tomorrow morning, very likely. If not, then it probably will be coming out on Tuesday. Usually it's the day before, so that'll give us a better clue onto what the unemployment rate's looking like. I still anticipate the unemployment rate to be moving upward, and going with the Challenger Gray report and some of the data we saw last week, I am very, very set on that. We should at least be seeing a 4.5%. I would not be surprised if it goes back up to the 4.6% that we previously had. Now we have Bowman speaking at 10:15 a.m. I don't care about that too much. We have the let's see. The next major data set for that day is the 10-year note auction. Now, we should at least be seeing a 4.5% for the unemployment rate. That's at least my expectation. I would not be surprised if it jumps back up to the 4.6% like we previously had. Now, at 1 p.m., we have the 10-year note auction. Now, the other auctions this week haven't been that important. This one is because it's going to be after all of this very, very crucial data. So, that will absolutely influence the 10-year treasury yield and the auction itself. So I do expect the yield on that to, if we get cooler data, the yield on that should definitely pull down slightly. If the data is not cool, then very, very likely the yield will pull up very, very slightly. Now, those are the main busy days this week. Now, we do have CPI on Friday. Obviously, that's going to be busy, but for its kind of own reason. Um, but Thursday, very quickly just going over this, we have the continuing and initial jobless claims. Kind of the same thing what I talked about beginning this data clip with how we've been seeing some oddities within the continuing and the initial jobless claims. Forecast has the initial coming in at less, but I still expect it to go upward. Existing home data, it's important, but not something I'm actively watching right now. The 30-year bond auction is at 1 p.m. Now, kind of the same deal with the 10-year. If all this previous data on Wednesday is looking like it's going to be coming in quite a bit cooler, then we should see the 30-year bond auction come in slightly, or, with a slightly lower yield. For Friday, we have the CPI data, both the month over month and year over year for January. Obviously, that's going to be very, very important. The forecast is expecting a slight increase on the month over month for January, but a slight decline in the year over year. For me personally, I'm still just expecting declines. Um, we've been seeing the CPI data for months now, just coming in cooler and cooler and cooler. And truly, I have not been on the whole inflation, um, uptick thesis. I know that we did see prices go up very slightly, and we might get even a very, very, slighter increase in the prices. But the overall inflation from the tariffs has really been stomped out. I'd be surprised to see inflation to be picking up at this point, especially when we're seeing the labor market have some very, very serious issues. And getting into this week's earnings, it shows a whole lot of earnings, but really nothing too important. Um, Truly, I'm not looking at any of these besides applied materials because obviously that's a super important semiconductor. There are some smaller companies that are important for, minor reasons, mainly the consumer market. I'm looking at Shopify, I'm looking at McDonald's, I'm looking at Coinbase, but right now crypto's been, kind of been selling off quite a bit, so really I'm not too interested in trying to play the options on that. DraftKings, I've actually had a lot of success in the past trading the earnings on, so it's always something I take a look at. Um, will I play it this time? I'm not sure. Overall, I really don't like the company. I really, really, really dislike online gambling, and I think it's a very bad thing for the society as a whole. So, really, we don't have very, very important earnings this week. Nothing in here is going to crash the market. Nothing in here is going to cause the market to rally like crazy. Um, Even if Applied Materials had a super poor earnings, it would not be enough to hurt the overall market. And the primary reason why is because it's not a US company, so it does not get the benefit of all that US market cap, kind of like the same with TSM. Um, oh geez, what's that other massive one I'm thinking of that I can't remember the name right now? I can't remember the name right now, but it's another massive semiconductor that's in Europe somewhere that again, because they're just not American companies, they're not going to get the exposure to the American market. So even though they do get some of the benefit of the market cap, it's not like people are just going to completely dump their money into a European company. That's just not how the United States market works. So overall, not a busy earnings week. Now, I did want to very, very quickly cover the Fed watch. It's interesting to see this because while I still kind of am in the boat that we're very likely not going to be seeing a rate cut come March, this is starting to actually increase. It went all the way from, it was actually at 12% something last week, all the way back up to almost 20% currently. Quite a bit of a change based on just some of just the basically the teeny bit of labor market data we had last week. Now, if the labor market data is still concern over the next 2, 3, 4 weeks, then we can absolutely be seeing this continuing to climb upward. And if that does happen, I definitely will be shifting my perspective of whether we will see a rate cut or a rate pause. But the reason why I believe we will see a rate pause is one, we have Powell being replaced in, I believe it's May. I want to say it's May 15th. I could be incorrect about that time and date, so don't quote me 100% verbatim on it. But Powell is leaving very soon. I Powell does not like Trump, but at the same time, Powell's not going to purposely do anything to hurt the economy and the market, especially when a brand new Fed chair is coming in. He will obviously take the higher ground here and give this new Fed chair a warm welcome, whether he agrees with the Fed pick or not. You have to remember the world of the Federal Reserve and some of these central bankers is top tier respect in terms of uh dealing with person to person. So I do think that the transition will go well. I'm not really concerned about that. I don't think that Powell is going to do anything to make that transition any more difficult than it needs to be. Um, if we do need to see a rate cut happen, then it will happen. Um, but I don't think it'll happen unless it's an almost necessity. It basically has to be a necessity for a rate cut at this point to really happen from here until May. Now, next thing I want to go into is the Challenger report. Now, I'm not going to read the entire Challenger report. I will link this in the comment below. I highly suggest reading over it because it's not a long read. It's only about 2 to 3 minutes long. Um, we're seeing some of the largest job cut numbers since I believe it's either 2009, if I read this correctly. Yeah, January 2009, which that's staggering. A lot of people think when the whole 2008 crisis happened, everyone thinks that the labor market and everything went down instantly. That's not what happened. It was a very long process. It was happening from all the way from 2006, really until I want to say that we didn't really clear that hurdle until about 2011. So this is a very, very concerning amount of job cuts, especially when we're in a labor market that specifically is not hiring right now. Um, Again, the JOLTS is a soft data set, it's not a hard data set, so it is a little more speculative in terms of opinion, but we have a trend that's been going very, very consistently here. It's been telling us a very, very strong story. And if you've been watching my videos over the last, heck, 3 months to 6 months, year now, then you'll understand why um this is such a concern. Uh yeah, I just wanted to bring that up. The last thing I want to end this kind of segment with is the temp hires. Is that this goes back all the way to 2016. Um, might just do it all the way to, let's do 2005. Let's do that. Okay. And this gives us a really clear picture of kind of what's going on. So again, remember I just discussed how the whole crisis of 2008 really didn't wasn't just a 2008 thing. It started happening all the way back to 2006, probably even before that. Um, a lot of different issues had to occur to really culminate to, excuse me, I said that wrong, culminate to create this massive recession, a massive issue. Now, with that said, when we see the temporary hires, and that's what the temp help services is, when we're seeing temp hires being heavily um, heavily employed, that's generally a good thing for the market. That's generally something that's saying we need those extra temporary people. Whether we're expecting higher volumes of customers, whether there's holidays, there's some reason why we need these additional temp hires. When we start seeing this drop, 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 generally that leads to recession. Um, we're entering some very dangerous grounds here, and this is very, very close to seeing a massive drop. Especially with if you read that Challenger, uh, Grand Christmas report, it will tell you almost exactly this story right there. If you've been going over the JOLTS data, if you've been going over a lot of the labor market data that we have been, this is nothing new to us. We do really expect to see a basically a massive, massive just pause in hiring and really for a lot of these temp hires to be let go. Now, the next set for this data is, let's see, February 11th. Um, oh, so it comes out this week. Interesting. Okay, so we'll actually circle back to this data set this week. So if we see this drop pretty drastically, then um, that will kind of continue to confirm what we believe we're already seeing.
If you're enjoying this, please check out my Patreon. For just $1 a month, you can join our community chat and access our tools like the Unusual Whale Spot and our own personal GEX and DEX market positioning. My $12.99 premium tier gives access to my personal trades, 2 live classes a week, which are on Wednesdays and Sundays, and direct support from myself. The links to join are below, but you can also join through patreon.com/wooksy. Thank you for supporting me to help you build skills for a lifetime.
And getting into the technical analysis, as always, let's ensure that our daily time frame, our moving averages, and Bollinger Bands are turned on. And let's get right into it. So we did see a little bit of a bounce from that lower Bollinger move like we discussed. Um, we had two different ways that was going to occur. Either the QQQ, and I really want to show QQQ because it basically piggybacked right off of this move. QQQ on Thursday started to pull down into the day two of its bottom Bollinger. Now, on that Thursday, it either had the choice to start heading back up to the 5 mile, and with the lower Bollinger rules that we set, day one we secured the lower Bollinger at or below the level that occurred. Day two, we expect a lower low into upward consolidation. We did see that. However, we did see a third day of extended bottom Bollinger movement. Okay. So now this is still telling me that it's going to consolidate back up to the 5 mile. However, when this move on Thursday happened, for the bottom Bollinger day two, this was SPY's day one of its bottom Bollinger move. Pull that back up. It was day one of its bottom Bollinger move, and it doesn't look like it right there, but it was. Um, with it becoming that bottom Bollinger move day one, that allowed SPY to have that deeper push into the bottom Bollinger day two. With that day two push, which was the day three for QQQ, that allowed the buying to occur within the SPY because, again, the standard rules of the bottom Bollinger, day one, secure the level at or below. We secured it. Day two, lower low. We got the lower low. And from that day two, between day two to day three and four, we start climbing back up and consolidating back to the 5 mile. We are seeing that movement both within the SPY, the QQQ. I said both, but I also mean within semiconductors as well. Semiconductors had a rejection off of the bottom Bollinger, and with that rejection, we are now seeing the moving averages start to climb back up again. They went from very, very bullish into this bearish consolidation. It's not out of that range yet, but with the overnight price action, it's already wanting to climb above the 10 mile range. So a lot of this upside push is starting to happen between the SPY. Again, the SPY still has room upward to reclaim that 5 mile test. From that 5 mile test, and based on where we closed on Friday, we closed at 690.62, which means that the 5 mile will actually be rising, and that's excuse me, that's changing the short-term trend because the 5 mile for the last few sessions now has been pulling down each session. This is a change in that trend. This is going to be pulling back up. It should be around that 689.60 range. It might be higher, it might be lower. Just make sure you write it down on open because it's a very, very crucial range. Now, with that discussion on the 5 mile, on the SPY, it's pulling upward. However, on QQQ, it's actually going to be pulling downward very, very slightly. Excuse me. Now, I'm not going to get into all the moving averages on the QQQ right now, but The QQQ 5 mile pulling down very, very slightly is still concerning. We do kind of want everything across the board to be bullish if we're looking for the bullish upside. But again, one or two sessions on the QQQ of bullishness can definitely shift the direction of that. Now, with the semiconductors, we are seeing the 5 mile pull back up. It will be above the 20 mile as of tomorrow. It won't be above the 10 mile. It will still be below the 10 mile, but one or two sessions of buying from that level will be seeing the 5 mile cross above the 10 mile. So semiconductors almost fully bullish. We have tech not entirely bullish yet, but starting to pull back up. We have the SPY, which again, that's kind of the mix between everything. Starting to pull back up. It's still going to be very, very consolidated with the 10 mile and 20 mile. Um, as of tomorrow's open, technically, I do believe the 5 mile will still be below the 10 mile and 20 mile unless we see some massive buying in the open and really pull that 5 mile level up quite a bit. Um, I really don't expect it to be too much higher than that, but we're seeing that heavy consolidation again. Now, we have talked about this consolidation, and while we have been in a very, 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 very strong consolidation for months and months and months now, generally when we see the 5 mile start to cross back up the 10 mile and 20 mile and break that consolidation, generally it leads to very large moves towards the upside. And one of the things that I've been looking at is that the upper Bollinger actually extended a little bit to the upside. And that will be pushing upward as of tomorrow's open as well. So it's finally cleared above that 700 range. It's starting to head towards that 701, 702. So while we are still quite a bit of ways from having that upper Bollinger move, this is extending the move of how high we can go in the current cycle and how low we can go on the current cycle. Our downside is really shrinking while our upside's starting to expand again. And that's something you want to see if you're, bullish on the market. I'm bullish on the market right now. That's something I want to see. Now, overall, um, we do have to be a little concerned with a few different things, but I'm going to show you on the drawings of why I'm still pretty bullish on this overall. This is going to look like a mess for a second, but I will explain this all. Now, again, the orange channel, that's a bullish channel. I have extended it out very, very slightly from this last support. If we have major selling continuing from the range I'll show you in just a second, then we will be breaking that buying channel. The blue channel here is a major selling channel. Basically, the expectation should be to trade to the top of the channel to the bottom, top of the bottom until that channel is broken. Okay. Now, one of the few things that I do want to show with this channel is that each time we've hit the bottom of that channel, which each time has been into that red liquidity zone, and this also goes back all the way to prior, but each time we push into this red liquidity zone, we see massive buying out of it. Each time that buying has picked up larger and larger, while the selling has also increased larger and larger. So it is creating a pretty large megaphone here, but that's not something I track too much. That's not what I'm looking for. I'm looking for structure. One of the main things that I see structurally here is that we do have an inverse cup that did finish. Okay. It looks very, very good. 100% agree, this is bear structure. We've seen multiple head and shoulders take us down. We had this first one right here, which is that's the left shoulder, the head at that all-time high. Right shoulder pulled down into the liquidity. That wasn't enough. Pulled back upward. We now have left shoulder, the head again, right shoulder, and really dug into that liquidity. Now, I have not changed where this channel goes towards the bottom, and if you look at it, it almost hit to the exact penny of where the bottom of that channel is. Um, and by the channel, I mean this red liquidity zone, because this liquidity zone has been here for quite a long time now. I mean, it's been here for months and months and months. If we drag it back out all the way, um, we'd start seeing some consolidating in here. That's really where that consolidation came from, is all the way back there. So we've been within these liquidity ranges for an extremely long time. Each time we enter this red range, generally we see very quick selling into it and massive buying out of it. As you can see, massive buying out of it, very quick selling into it, massive buying out of it, very quick selling into it, massive buying out of it, very quick selling, massive buying. Next time we get to that channel, very quick selling, massive buying, and then we have, what many would call a collapse. I call it a collapse. It's a moving average collapse. The buyers just tapered out here, and all the way back almost to the penny of the bottom of that channel, and now we're seeing massive buying again. So my expectation is that if we're seeing this trend continuing, and it even continues back here, oddly enough, I just did not track it at that time. I'm going to put an arrow there just to make this a lot more easier to see. But as you can see, small buying, small selling, larger buying, larger selling, even larger buying, even larger selling. If we're going to stay within this pattern, then we should see buying all the way to all-time highs. Um, and then we should see selling below that. Um, so that's really the expectation right now, is that we should be seeing quite a bit of buying. Now, there are a lot of macro conditions that can shift this buying, and we will be covering some of those in just a few minutes here, but the structure's looking very good. This looks very value gap filling. Excuse me, I can't talk very well. But basically, each of these buying gaps or each of these selling gaps is bought up. Okay, selling gap, bought up. Selling gap, expectation should be bought up. And the reason why I'm really looking at this area is because this is above this selling channel. That would mean that the selling channel would either very, very likely have to expand upward, or we'd be seeing this selling channel entirely breaking and seeing massive buying to the upside. So yeah, that's what we're looking at. Um, we do have quite a bit of a double bottom going on right here. We did break some of our bullish structure previously. That's really what this red bracket was showing, is that there was this massive chunk of liquidity that really has been ignored. Um, and I was surprised they didn't take it sooner. They finally took that liquidity, they filled that gap. Um, Technically, we don't need this anymore. With that said, um, things do look very bullish right now. Even if this is just purely to create more liquidity to sell off even harder, it looks very, very bullish. Now, we're still not breaking out of this consolidation channel yet, but that's kind of the next step, is to look for the 5 mile retest and look for not only the market price, but the 5 mile to break above this white consolidation channel top. Once we break above that channel top, there really isn't a whole lot of room left, because either we're going to reject at the top of this channel again, or we're going to see buying to all-time highs. So it looks very, very good, and we do see that reflected in QQQ. I don't have the drawings set up, but we do see that reflected in QQQ, and we do see that reflected within semiconductors as well. Um, Geez, that's an old drawing. That's from probably a half a year ago. And yeah, we're seeing this with semiconductors as well. So um, it looks very, very good in terms of buying with semiconductors, tech. and the SPY. We're also seeing the ADL in each and every one of these picking up pretty massively. We had that fairly large selling, but a lot of that weight has been bought up already. And we also see that within the SPY. We really zoom in on it. We're not all the way there yet, but we've largely bought up a large chunk of that selling. So do I think all-time highs are very, very due and coming soon here? I do. I do. I'd be surprised if we don't see that happen. Just based off of some of the price action we have been seeing. Now, what I want to get to next is just very quickly taking a look at the high yield corporate debt. And again, the reason why I take a look at that is because if the high yield corporate debt is selling off, then that means that very, very likely and historically that equities will sell off with it. Now, last week I made the statement a few times that the selling didn't go anywhere. And we see that very clearly within the HIG. Last week's selling didn't even make a dent. Compared to some of the previous selling we saw, even at the end of last year in quarter four, the selling didn't even make a dent into the high yield corporate debt. This looks like just a tiny little dip before a massive, climb into all-time highs again. I mean, it just looks like a blip on here. Same with liquid. Liquid's a little more bouncy because it covers just a little bit of different price action. Um, but again, this is the investment grade corporate bonds, so it's not the exact same as the HIG, but it's still tracking somewhat similar. We're seeing the ADL flying here. We're seeing buying picking upward, and within junk, which always makes me laugh. I think it's a funny name, but it's an ETF like HIG, if I can find it. And again, we're seeing the ADL picking upward. We see the selling not even make a dent. It didn't even break the previous selling we saw in January. The ADL is looking like it wants to pick up to the all-time highs. Same with the HIG. The ADL has just been flying. So high yield corporate debt looks absolutely fine. Nothing in here right now is telling me that this is getting ready to jump off a cliff, that we're getting ready to see massive volatility. Nothing here is telling me that. Um, this is kind of telling me that it looks like this type of moment where it's just a tiny bit of volatility before we see massive buying again. Um, this would reflect into the equities. This would show that, continued buying above this level would mean and very likely would show that the equities, so SPY, a lot of these tech names would be running into the all-time highs again. Next, I just very, very quickly want to take a look at Treasuries. Now, again, the main thing with Treasuries that I've been looking at is that there is a ton of macro factors that can be at play. We have the United States debt being, absolutely soaring and having really no pullbacks on in terms of the government spending overall. Yes, I know there's some pullbacks here and there, but nothing substantial to cut the debt down. Okay, that's one of the main thesis that the bears have for TLT going downward more is that the US is going to have to continue to sell their debt, and that bonds are basically going to continue to degrade and degrade and degrade and expect a higher and higher and higher yield. I don't share that sentiment. Um, we're not going to look at the whole moving averages and Bollinger Bands and everything, but I just want to look at a drawing here. And this is still holding very true, even though our buying channel here is seeing a little bit of breaking with the consolidation, but we'll discuss that at a different moment. However, each of these red circles is a lower Bollinger move, which means that generally that's when you buy. These two lower Bollinger moves have not been successful. They have not given us massive buys to the upside. Uh, like standard. It's standard that generally when you buy the lower Bollinger, you're going to see some massive buying. Now, TLT has been in a shaky spot. It's been sitting at the very bottom of this consolidation range. However, you can still see this cup and handle holding very, very strong. It has not broken yet. And until that breaks, which that means this would have to pull all the way below that 80.56, then this is still very good. This cup and handle is still showing bullish liquidity. Going over the US 10-year, um, again, it doesn't allow me to draw on the US Treasuries for some reason, but we still have our downtrend holding very, very strong. Even in the short term, just the year-over-year downtrend, that is still holding very, very strong. We had a little bit of a bump in the yields overall. There's been, again, a ton of macro conditions. Um, we have a new Fed chair coming. We have the Bank of Japan having to unwind their debt and everything. But one of the main things that I want to show about this whole unwinding process is that, and I want to turn off the drawings, but the last time we had Japan really, really unwind their debt or unwind the yen was back in the end of July, early August of 2024, and that was back when TLT hit actually 99. It says 95.6 right now, but that's because of the dividends. It hit 99, and from that range, we saw TLT drop and drop and drop and drop. Started climbing back up again, and then it started to drop, and then started climbing back up again. We saw the early January selling, which also was some of that Bank of Japan unwinding. We saw it buy back up again a little bit. We saw the April selling, and then we saw it buy back up again. We have a ton of macro conditions. I keep saying that, but we have not been seeing this selling really breaking any significant ground yet. We have not been seeing um, the Bank of Japan unwinding, absolutely dumping treasuries and then causing it to buy back up. We have not been seeing that yet. So for now, treasuries are still just kind of in a hiatus mode. It's very, very awesome to still be adding shares to TLTW, but adding contracts right now, anything short term, we do need to wait. We do need to wait for the new Fed chair to take his position or to start his tenure. Um, we need the Bank of Japan to start seeing a little bit of easiness happening with the yen, or a little bit of strengthening within the yen. We need to see some of the macro conditions change a little bit. We need to see um, the Fed being in the stance to really start rate cutting again. If they're going to be pausing rates, then TLT will be sitting in a super heavy consolidation for a very, very long time. That really reflects through the futures as well. Just going to very, very quickly look at that. Futures pricing is showing that as well. However, within the futures, you do see the ADL. So people are buying this up. It's just very slowly. People are adding very slowly. We know that banks have been adding the dips the entire year. Um, the entire time last year when they were telling people that basically bonds are are just not the place right now. So, um, I'm bullish in TLT, but we still need to see some consolidation. We still need to see some real life events change a little bit. Now, I want to quickly go over the dollar, and that is that the dollar has still been pushing downward. I have my old drawings here. It's been holding very, very true to this massive selling channel that's been holding, true for weeks and weeks and weeks and weeks and weeks. This selling channel, I want to say it started what, 2022? Yeah, in 2022 when we saw the all-time high, and it was actually up at 116. It says 114.78, but I think that's because of either a dividend or something else. I know DXY doesn't have a dividend, but um, it was up to 116, unless I'm crazy. With that said, this selling channel has immense weight to it, and what is still telling us is that the dollar wants to see downward. Okay. With this previous consolidation channel being broken, you can see that the previous attempts to push back into it have pretty much been failures each time. First time, fail. Second time, fail. Third time, didn't even make it, so another fail. Fourth time, very, very likely will not even see it hit up to that level. Now, the main concern is that with this selling channel being so large, is that it does create the potential room to, run from the bottom to the top, which I don't think that's going to happen. Um, but when we're at the bottom of a channel, it makes it hard to suddenly drop below that channel because that's just not how these channels work. I have not edited this channel for I don't know how many years now. It's been holding very, very true. So take that with a grain of salt. I do expect the dollar to pull up very, very slightly, but overall, I do think we're kind of out of the woods of this 99 area. I don't really expect it to pull back up to that range unless we see a larger macro event cause the dollar to massively strengthen. But I do think that um, with the Bank of Japan having to sell the dollar off and a lot of the different macro conditions we're seeing right now, I do think that the dollar will continue to drop. And we're seeing the yen, which is the FXY, not exactly at the spot we wanted to. We want to see this climb upward. It's been still very, very weak. When this is weak, this means that the Bank of Japan can continue to unwind, which is when we see a ton of equity selling, a ton of treasury selling, a ton of, just a ton of security selling. So that's something we always try to keep, watch of. On the USD JPY pairing, we do see that there is this very nice daily cup, potentially forming a handle right here. So potentially this is telling us that this is going to want to break out to all-time high, new highs and give us all new trouble again. So it's not like we're out of the woods on that. Um, just something I wanted to look at with the FX pairings. Now, next we're just going to very, very quickly take a look at the VIX. Now, this is the standard VIX. This isn't the VVIX. We will be looking at that afterward. Um, with the standard VIX, again, there is kind of this rule that I have where it needs to be below this $20 range to signal bullishness or above it to signal bearishness in terms of larger trends, right? We're still at the 1776 range. Based on the overnight, we are seeing UVIX and UVIXY down quite a bit. So very, very likely the VIX is going to be opening up probably around that 13, 14, $15 range, which is showing tapering of the selling. Um, again, VIX has been within a very large selling channel for a very, very, very long time now. It doesn't look like this on this chart, but it has held that channel for a very long time. And I'm not within the camp that's really expecting volatility to climb upward right now. I know that this is the historical quarter for some of the weakness. I know last year we did see a ton of selling throughout February, March, April. So I know a lot of people are really anticipating the volatility to start increasing again. One thing that I really want you to be aware of, though, is that outside of these massive, massive pops, generally the VIX is going to be downtrending and holding a very low level. Um, it generally holds around this 11, I want to say 11, but really around this $9 to $11 range. And it will hold that level for quite a while. have a very small pop upwards, and then pull back down and hold that level and kind of just consolidate around that range. Doesn't really go below that too much, doesn't really go above that too much. Again, these volatility pops are very, very short term. Even some of these smaller ones, you can see they're very short term. So am I expecting major continuation within this current volatility move? No, I don't. I expect it to taper down and, slowly close off some of that volatility that's been building up, and then we can see, another volatility move happen from that. But in the current cycle, I'm not seeing that. The one thing that is very, very concerning is that the VVIX is still very, very elevated. Now, again, the VIX and the VVIX track different things. The VVIX is actually tracking the insurance on the equities. So, with the VVIX increasing in price and being above this 98 range, it's highly, highly suggesting that the insurance premium is elevated right now. Um, we're not out of the woods until this really starts pulling below this yellow range and into the green range. That green range is really where what suggests that there's going to be massive buying to the upside. The yellow range is still that cautionary area, while the red is this, major selling range. As you can see, the VIX likes to chop up, down, up, down, up, down. It pops up and down very, very quickly. It's very reactive. Um, Again, I've seen this thing move like 20, 30, $40 in a day. So if there's going to be continuation within the selling, we will see this $100 range held and pushed above. However, if we're going to be seeing the selling taking a break, like I assume it will be, then we should be seeing again it push below this yellow range into the blue, excuse me, the green. Now we're going to very quickly go over silver and gold. Let me go ahead and pull up the Bollingers. Isn't the drawing I want you to see right now. I want to go to the actual silver, and this is the CAG silver futures. And as you can see, we're exiting a lower Bollinger move. Again, lower Bollinger moves are one of the primary buying opportunities that you can ever have. Every time we buy the lower Bollinger move, we've been very, very, very profitable. The last time we bought the lower Bollinger move, it did not go all the way to the lower Bollinger, but I still mentioned to people that we should be buying that range. We were able to buy, um, you know, at that 45 range all the way back up to 120. Now, granted, the price has dropped a whole $40 an ounce. However, all of our support is still above us. Um, with gold and silver exiting their lower Bollinger moves, again, it's suggesting bullishness. It's suggesting that this was enough time to cool down. Um, if we see these 5 mile retests being successful, which again, that's the next step from the lower Bollinger move, then what comes after the 5 mile? The 20 mile. Okay, so the 20 mile on silver is up at the basically the 93 range. Um, Plenty of upside on silver right now, and that's the actual price of silver, not the silver ETF. On the actual silver ETF, that would suggest the price climbing back up towards that 84-ish range. So from where it is right now, that would be a whole $10 upside just within the silver ETF. And that same sentiment really carries over to gold as well. As you can see, the gold main. Now, the gold main did not sell down to the or down to the lower Bollinger. I do believe the gold ETF did though. No, the gold ETF did not either. It just did a 20 mile move. Still very large move for gold. Um, Again with gold that took the price all the way from basically 5,500 down towards that 4,400. Now, with gold and silver, I'm still very, very, very bullish on them. I do heavily think that gold will be pulling towards that 6,300-ish range before it really tops out for, this current market cycle, and that could be the next few years, however long it'll be, but I do think it will be pulling up towards that 6,300 range, and every other precious metal would be resembling some sort of that sentiment, palladium, platinum, silver, they're all going to be gaining some with gold and silver. I mean, silver had, I believe, over what, 5 trillion market cap not that long ago. So big money wants to be into this. Big money wants to be into precious metals right now. And that's a whole nother video of why I think so. But um, the upside is very large right now throughout probably the majority of precious metals. And that not only extends to precious metals, very likely it extends to gold miners as well. So definitely take a look at those. You can have some massive opportunities. Now, finally, we're going to take a look at Bitcoin and then oil. Now, with Bitcoin, I've been tracking Bitcoin for literally years and years and years, and I'm going to pull up my drawings. Um, these have been on here probably since 2022, besides some of these structural ones. Now, we've been holding this buying channel for a very, very, very long time, and one of the funny things is that we almost hit the exact bottom of that buying channel. Um, on the daily time frame, if I actually pulled that channel into the correct path, which will take just a second here to correctly load it all, but let's go ahead and go back up. And yeah, the bottom of that channel hit almost perfectly. I'm actually, I'm so surprised by that. I have not edited this thing in I want to say over a year now. When's the last time I've put a ping down on this? Last ping was in October 21 of 2023. So that's when I was really tracking the bottom of that channel um for this yellow buying channel. Now we have broken out of this orange channel, so we are I want to delete all the drawings now. Um, we will delete that orange channel. However, we're still within this very, very bullish yellow buying channel. With us being in that very, very bullish yellow buying channel, with us having a double bottom starting to form here, and again, this does look very bearish right here. However, I don't think it's all that bearish because we can create an inverse head and shoulders very, very easily here. Now, again, we've been talking about how at the very, very bottom of this large inverse cup, we did anticipate it to start building bullish structure in this area. It did go down a bit further. Um, Still part of what we anticipated though. It didn't really push too far out of expectations. We did have this very, very, very large support range at this 74.4 thousand. It has been broken below. However, I still think that's going to be a very crucial level. And by crucial level, I think that very likely we're going to see the market price um, reclaim that level and start building a lot of support at that range to push back upward. Overall, I am bullish on Bitcoin. I was really looking for kind of the bottom of this range to be taken. Again, it did push a little further lower than what I expected. However, this still was within the expectation. With that expectation, with this still being bullish overall, um, I'm still bullish on it. That means that I'm expecting a lot of buying towards this upside again. If we see that inverse head and shoulders that I just showed you, then we're going to start gap filling this entire way back upward. Okay, and I want to make this red so it really shows. Maybe I'll make it orange. Um, so that the expectation really should be is that clear that 74.4 1,000 major support, start building back up towards the um, lower consolidation channel. Once we get into that lower consolidation channel, build support at the bottom of that, break this selling channel, and then head back up again. So that's really what my expectation is out of Bitcoin. With the dollar still seeing, still being in a selling channel and everything overall, I still expect Bitcoin to see some strength from that. There was a large correlation between Bitcoin and the DXY for an extremely long time where if the dollar dropped, Bitcoin would rise. If the dollar was gaining, Bitcoin would drop. Well, we did see that small cycle over the last quarter where we've been seeing a lot of struggling with the FX market, especially collateral with the Bank of Japan and everything. And very likely that was the large reason this was pulling down. With the new Japanese PM and everything, we've been seeing Bitcoin having a massive amount of buying. Um, could this just be a small blip before more selling? It could. But again, I do expect some of this upside support to be claimed. We have the 5 mile that's being retested right now. From the 5 mile, we should be fully anticipating the 20 mile. So again, I am bullish on Bitcoin. I did buy some IBIT when we dropped down. That's the BlackRock Bitcoin ETF. I forgot what price I bought it at. I want to say it's $21 a share now. It does pay a dividend. It's something that I actually suggest kind of everybody should be trying to add some shares to their account. Oh, it's actually a lot more than that. It's $40.37. So I bought my shares. Hold on. I'll tell you the exact price I bought my shares at because I'm really proud of this one. One moment. I bought those shares at 38.83. So not the very, very bottom, but I timed it pretty dang close. I am proud of it. So, um, yeah, that's Bitcoin. Let's go ahead and jump into oil, and I'm going to look at USO specifically. And one thing that I've specifically been looking at is that oil's been seeing a ton of buying. And with a ton of buying, that's that can suggest a couple different things. One, this could be entering a major bear trend or a bull trend, excuse me, where we're going to, continue seeing this price escalate and escalate and escalate. Or there was some sort of event that caused massive buying. Now, with oil, generally when you push that upper Bollinger, you generally see major weakness start to occur from that. Seeing a little bit of that happening. It's not, entirely happening yet, but again, I do still expect oil prices to drop. Um, I'm not in the inflation camp. I don't think that inflation is an upside risk. I think that more so people need to be concerned about the labor market. And this is the weekly time frame on USO. We're also having a weekly upper Bollinger push, which means that from each weekly upper Bollinger push, generally we see large selling. This is probably one of the only examples where we see it sell downward, consolidate, and then pick back up, almost have another weekly upper Bollinger move, and then start dropping down massively. Um, we do see the ADL on the weekly time frame um, dr- jumping up pretty massively. So that is something we definitely can't ignore that. But with these multiple upper Bollinger moves occurring, that does kind of tell me that very, very likely oil will cool down just a little bit. And if I remember correctly, we are seeing that in WTI as well. Um, WTI also on the weekly is seeing this push above the upper Bollinger. Now, again, it doesn't always sell down massively each upper Bollinger push, but generally that's the expectation is that you will see a little bit of selling to the downside. So with, you know, sorry, my brain just kind of zoned out there for a second. With seeing some of this elevated selling or elevated buying within oil, within the WTI, within some of these major oil companies like Zom, Exxon, uh, Shell, you name it. Things need to cool down a little. Now, are we at that point? Maybe not entirely. Um, but I do know that from these upper Bollinger pushes and consolidation, eventually it will lead into a collapse of that 20 mile level. And silver is a very good example of just that. So you see how you push above, you're going from upper Bollinger to 5 mile, upper Bollinger to 5 mile, rinse, repeat, and then all of a sudden it collapses to the 20 mile and below that. Very, very likely we will see oil have some sort of move like that if it continues having upward buying. So if we do continue seeing oil running extremely hot without having a 20 mile test, then very likely I will be trying to tack on some oil shorts. Now, granted, I am long in WTI. I have shares between the $1.70 to $1.80 something range. I know some people entered before I did, and lucky you guys. That's something I really wanted to enter right at the bottom. I was really looking for that 1.5 or even 1.3 range. Totally missed out on that, but um, we're not out of that ballpark just yet. But I do expect oil to slightly cool down this week, so just be aware of that. Um, very likely some of that tech selling led to some of this oil pricing rising with my expectations of tech seeing some bullishness. Very, very likely we will see some oil or, some of the commodities have some weakness. So, yeah, I think that covers everything for tonight's video. Thank you all who stuck around and listened to it all. I will be streaming in the morning and we'll be going over a lot of different things that I talked about today, but um, from now on I want to try to be around a lot more. Um, if you have questions or comments about a specific symbol, feel free to ask me. During the live stream will be a great time because I can just pull up the chart and go over it right then and there. So again, I'll be live at I don't remember the time. I live on the West Coast, so I always have to say I'm starting at 8 a.m., even though for me it's at 5 a.m. So from 8 a.m. till 9:30 a.m. I will be streaming Monday through Friday. So I look forward to seeing you all there. Other than that, I hope you all enjoyed this week's video. There's quite a bit of plays opening up right now, so that's why I made kind of a longer video. There's a lot to go over after some of the selling we saw over the last few weeks. So yeah, with that said, let's have a great week, everyone. Take care, and I will talk to you tomorrow.